providing financial straight talk for those working and enjoying life after work. This is America's financial headquarters.
I have another article here that just was out in Investment News very recently, and it says that $300 billion, that's with a B, $300 billion has been yanked from actively managed U.S. equity funds over the last 3 years. So that means that much more money left than came in. So that's like a net number. So over $300 billion has walked away from these actively managed U.S. equity funds. And what's interesting is over half of that money, $160 billion, is still sitting on the sidelines. So, we'll need to talk about that and what that means, because basically you're dealing with very low interest rate environment here. So where is that money now? And then the other $140 billion has been redirected into what's commonly referred to as passively managed funds and or ETFs, which basically means these people are eliminating the thought process. They're eliminating the money manager. And they're just trying to track and keep up and mimic the indexes themselves, whether that's the S&P 500 or the Dow Jones or whatever the case might be.
Let's first talk about the $160 billion that's sitting on the sidelines. Where do we think it's sitting?
Well, it's sitting by default in very low interest rate environment. So if it's in a money market, you're basically earning nothing. If it's in a savings account or a checking account, you're essentially earning nothing. If it's in a one-year CD, the national average for a one-year CD right now is 0.75%. So less than 1%, 3/4 of 1%. A 5-year CD is running at a national average of 1.42. So imagine that, someone locking up their money for 5 years, they're not going to touch it, at 1.4% interest.
It's the big question to me, as we dust off the crystal ball, is where are interest rates going to go in the future? And if you look at what Ben Bernanke said on September 13, his announcement basically said that the U.S. government was going to buy back $40 billion of mortgage debt each month with no necessarily end in sight. And to piggyback on that, he also said that they're going to push back their deadline for raising the interest rates. The interest rate environment, is nil, and they've pushed it back from 2014 to 2015, which basically means we aren't going to see...
interest rates aren't going anywhere.
Right. We aren't going to see that for a few years. So, the question becomes, as a consumer, where do we put that $160 billion that we might have sitting on the sidelines? Where is it that the best place to go for it?
Yeah, and there are alternatives. We'll talk about that. But, if you're looking for an actionable item, go out and refi. Go refinance right now. You've got interest rates on a 15-year refi running at 2.85, on a 30-year mortgage, 3.5%. College tuition has just increased at its lowest rate in over 40 years. Now, it's still an increase, but the lowest over 40 years at 3.9%. Now, the downside is that's still about double the inflation rate. The inflation rate's been about 1.99. So, college is always going to be expensive, but at least that's starting to slow down a little bit because of all these low interest rate environments.
Sure. So now we did put out a report recently on financialhq.com that's titled Alternatives to Certificates of Deposit, Combating this Low Interest Rate Environment. So if you're looking for some alternatives there are a number of suggestions in that report. You may want to go there and go ahead and download that.
Helps you gain some strategy, and it's free, so go to the website.
Sure. Now let's discuss real quickly that $140 billion that has redirected from active management into passive management. Why do you think that is?
Well, I think they're looking at their managed mutual funds and saying during the crisis, look at all the money I lost. Why am I paying for management when I got my shirt handed to me? And, I've been trying to dig out of this hole ever since. I might as well, if I'm going to stay in the market, I might as well just go ahead and take a passive approach. But if you're going to go down a passive route, you got to stop and think, what are you trying to really accomplish? If you're going to try to invest in just the S&P 500, maybe there's some strategy that would take those 500 stocks and try to identify the stocks within the 500 that are the wise ones to own, because the S&P 500 or the Dow Jones or anything like that is just an average. So maybe there's a smarter approach to figure out the stocks within that.